Good day, everyone. Mark and I like to take you through an update of the Strategic Metals Fund and share with you some of the observations as we head towards the mid-year. The fund's reported strong performance in the year to date, and especially over the last 12 months, as both bookends of the fund has performed in unison. That is the precious metal sector as well as the battery metal sector. That's the lithium, the nickel and copper. Coupled to that, we've seen a pickup in M&A activity, which really hits the sweet spot of part of the investment criteria of the fund. So I'll take you through some of the observations on the precious metal sector, and then I'm going to hand over to Mark, who will discuss the other metals and also wrap up the current structure of the fund and discuss any changes that we've made to the fund over the past few months. So firstly, just discussing on gold, we believe that the structural tailwinds, that is the global fiscal concerns and diversification of central bank reserves, that really lifted the gold price above $4,000 an ounce at the end of last year, those remain firmly in place. If anything, they've probably strengthened in recent weeks with the standoff in the Middle East. Since 2022, gold's primary price anchor has shifted. Historically, Western investment flows dominated the price action, with gold trading mostly as a function of market-related factors such as real rates, the dollar and risk sentiment. That regime has changed considerably since 2022. The freezing of Russia's foreign exchange reserves in that year fundamentally altered global gold reserve behavior. Excess reserves that once flowed primarily into US treasuries increasingly moved into gold. As a result, gold has become more tightly linked to reserve accumulation by central banks, sovereigns and sovereign wealth funds, more so than traditional portfolio flows. This matters because reserve accumulation is inherently cyclical. It depends on trade surpluses, export revenues, and critically in the current environment, commodity income. When those flows slow or reverse, gold demand at the margin weakens. Now, the start of the conflict in the Middle East had two immediate negative impacts on the gold price. Firstly, the buildup of excess foreign exchange reserves amongst the Gulf states was disrupted as a result of lower energy flows, as well as the inability to move gold around the world. Secondly, gold was used as a source of liquidity by the Gulf states, as well as by other nations, for budgetary purposes and to protect their currencies. Investors in the West joined the downward trend and liquidated some of their gold holdings as well. What followed in the weeks afterwards was a pivot on interest rate policy expectations by investors. Suddenly, with oil prices rising, inflation risk was elevated and investors started being concerned about rising interest rates in the short to medium term, not falling interest rates. And Western investors have typically sold gold when interest rates are rising. So interestingly, all the selling in the West was absorbed by accelerated buying in the East, predominantly China and India, as well as continued buying by central banks and sovereign wealth funds. Where we sit today is that policymakers are viewing inflationary pressures as being very short-term in nature and are delaying making any major fiscal policy changes. However, the reality is that debt levels are rising, and they already high at close to 40 trillion in the US. Deficits are widening, and central banks face increasingly constrained policy choices. If the energy shock persists and growth deteriorates, the probability of renewed large-scale liquidity support, that's QE or quantitative easing, rises materially. At that point, the debate shifts from theoretical to actual debasement. Historically, that transition has been powerful for gold. Remember that the pickup in inflationary pressures is initially deflationary, which can be negative for metal demand across the board. And it's a response of the policymakers in cutting rates in the face of a slowing global economy that really drives precious metal prices and ultimately all commodity prices. Given what I've just said, it seems that the volatility in the gold price will persist for some time until we have a clear vision of where the issues in the Middle East is headed. and also the time frame of the next rate hike or the next rate cut. Although from our viewpoint, we see that the risk is greater that the gold price will start rising as opposed to collapsing back to $3,000 an ounce. And this is why we're maintaining a 60% exposure in the fund to precious metals, because Western investors sold gold in the form of ETFs in the pullback from $5,500 gold price in January, and they aggressively sold or shorted gold equities to such a level that they were, and they still are, by and large, in our opinion, discounting a gold price of around $3,000 an ounce in their market valuations. Those who know the fund well know that we have a preference for investing in mid-cap, high-growth companies and world-class development plays. And this has definitely paid dividends for unit holders in our fund, as 3 companies held in the fund out of a total of 37 have been subject to takeover bids in the past month or so. The reality is that gold and silver companies are recording record cash flows right now, which is going towards strengthening their balance sheets and going towards aggressive share buybacks. M&A activity is definitely on the rise again, and we would not be surprised if we see more of the companies that are held in the funds being subject to takeover bids in the coming months. Silver, meanwhile, has behaved differently and with greater volatility. The price of silver set a record high of above $121 an ounce in February this year, and then pulled back to the mid-60s before recovering to over $80 an ounce, and now pulled back to just under $80 an ounce. While macro flows largely drove gold's move, silver price action has been heavily influenced by options positioning and market structure. In simple terms, derivative activity, not underlying fundamentals, has been the dominant driver of short-term price movements. That said, the medium-term backdrop for silver remains very constructive in our view, with physical demand continuing to outstrip supply by some 10 to 15%. In China, where the bulk of the physical trade is conducted, the price of silver consistently trades at a 12 to 13% premium to the price that's reflected in New York. At the moment, it's currently just under $90 an ounce. In March this year, Chinese silver imports hit an all-time high of 27 million ounces for the month. That was driven by a rush of solar panel exports and retail investors looking for a cheap alternative to gold. It's also coincided with China's removal of export tax rebates on April the 1st. Similar to gold equities, silver equities are discounting a silver price close to $55 an ounce, justifying that continued overweight position that we have in the fund in silver equities. At this point, I'd like to hand over to Mark to run you through the fund, how we see other metals, and also give you an idea of where we're sitting in the fund right now.
Yeah, thanks, George. I think it's important to frame the discussion of the broader metal markets in relation to the energy crisis, if you can call it that, and the Iran-US conflict. And the effective closure of the Strait of Hormuz, now entering its 11th week, has a major consequence on energy prices, and the emerging impact that has on mining costs and mining volumes is increasingly being posed to us by investors questioning whether they should be investing in energy intensive industries. And diesel actually remains the single most important energy input in global mining industry. Although mining only accounts for between 7 to 10% of diesel consumption globally, mining has a particularly high exposure to the internationally traded part of that market, with well over 25% exposure. And as a function or a quirk of nature, the major mining jurisdictions are also the major net diesel importers, and that's Australia, South Africa, Brazil, Chile, Indonesia, which all produce a suite of metals. And that will have a consequence on supply and demand and metal prices going forward. So we increasingly are being asked, well, what's it like in a $100 barrel new oil price environment? And what that has an overall effect of about 3 to 15% cost increase on the mining companies over an average of the industry and over all commodities and all mining methods. The influence of that cost creep really then depends on the specific mining company, the mining margins that that company operates under, and also the associated margin compression from higher costs. So one number doesn't really fit all, and what you can do and what we've done to try and mitigate this energy inflation is to invest in companies with lower energy cost exposure. For example, the gold and the copper miners are best positioned here to absorb higher diesel costs because they've got larger operating margins. The gold industry around 60% and the copper industry around 50% currently. Whereas if you look at the nickel miners, they have the lowest margin of around 14% and so are more exposed to higher energy prices. On the nickel mining, the nickel miners in Indonesia, a lot of them sit around the fourth quartile of the cost curve. So that's the higher end of the cost curve. And there are anecdotal reports that I'm reading that the Chinese HPAL operations, that's a high pressure acid leach operations to produce nickel in Indonesia, are closing in production due to high diesel and sulfuric acid shortages and higher associated prices. So what does this mean for our fund? Well, in metal markets where the supply and demand are finely balanced, which actually is most of the metal markets we currently invest in, and that's due to the political onshoring and stockpiling and the restricted inventory trade flow that we're seeing, metal prices are rising, which is good news for equity prices. Any production delay or shortfall from higher energy prices or acid shortages actually at the moment has a larger effect on the metal prices than under normal scenarios. So again, in the short term, we've benefited from these higher metal price environments in the fund. If we look at the copper market, for example, copper prices moved to record highs of over $14,000 a ton, and that's on the back of reduced SXEW solvent extraction electrowinning copper supply, which needs acid to leach the copper. And 20% of global primary copper comes from SXEW operations. So you can see that's having a negative effect on supply, positive effect on metals. On top of that, we've got Grasberg, which is one of the largest copper gold mines in the world. They've delayed their restart now to 2028 to get to full capacity utilization. And then on the demand side, on the positive side, we've seen increased demand from China on their domestic infrastructure grid investment scheme. And just to give you an optic here, every $100 increase in acid price is about a 4% delta on the cost of a copper miner. If we look at the nickel market, given that 50% of the world's primary nickel supply comes out of Indonesia, the nickel price is exposed to any Indonesian supply constraints. We've had quite a few of those. So in April 2025, the government, in their wisdom, decided to hike royalty rates on the nickel mining industry. They took that up from 10% to over 14 to 19%, depending on the operation. Then in December 2025, the same year, they decided to cut the nickel-bearing ore production quotas, the actual tons mined in the country, by 34%. And that was in an attempt really to try and rebalance the global trade, which was in oversupply, largely because of Indonesian cheap supply coming onto the market. Then in 2026, as we all know, the US-Iran war cut sulfur exports to Indonesia, where they restricted effectively sulfuric acid going into the country. And Indonesia sources 75% of its acid from the Middle East for its nickel operations. So you can see that this all has a knock-on effect, and the nickel producers, the HPAL operators in Indonesia, their costs have risen $4,000 a ton. Interestingly, that was directly priced into the LME Class A nickel price, and because of supply shortages, increased demand, and effectively the global trade of investment into hard assets, nickel prices have risen from $15,000 a ton to $25,000 a ton. On the lithium side, actually an unintended consequence of high energy oil prices has been a renewed focus on renewable energy and electric vehicles. The spodumene price continues to rise in China. It's gone from their lows in 2025 of around $600 a ton to over $2,800 a ton today. And you know, we've got around 12% exposure to lithium in the fund. The supply of lithium ore has been constrained by export controls in Zimbabwe and the crackdown on low-grade and polluting spodumene and low-grade lepidolite sources in China. That all means that we're getting supply restrictions while the demand side is increasing. Supply deficit, higher metal prices. On the demand side, we've seen a huge increase for demand for batteries in these stationary storage area, and that's in China alone. That's increased fivefold since January 2024, and really the demand in these stationary battery storage market has really offset any demand weakness from Western EV market. So you've got the Chinese market growing very well in electric vehicles, and then in the West you've got the demand pull from stationary storage and AI data centers. So not surprisingly, we're seeing the spodumene prices are really following the carbonate prices, and so that's good news for us as well, because we have some integrated lithium investments in the fund that take advantage of higher battery prices. And just to remind our investors and future investors is that the lithium market will need to roughly double in size every 5 years in order to keep a pace with the electrification aims of the world. While there's no geological shortage of lithium, it's estimated that we'll need a staggering 140 FIDs or financial investment decisions on projects in the mining space to meet the lithium demand over the next 10 years. And from my experience, the decision to go to financing a project can have extended delays, and we don't see the supply will meet demand in the lithium market in the next decade. Hence our exposure in the fund to lithium. The next sector of the market is really the critical metals and minerals needed in the defense industry. And this is really front and center at the moment, where the US critical minerals policy has really been a game changer for us in the critical metals market. And that's mainly at the moment in the rare earths, the graphite and zinc, whereas the US government have invested over $18.6 billion in critical minerals landscape in over 60 projects that are funded or part funded now. They've extended loans and guarantees to the tune of $100 billion so far. And given that the US has many policy vehicles, the One Big Beautiful Bill that Trump named, the Defense Production Act, and the Project Vault, which is funded by the Exim Bank, the US will probably be able to fund hundreds of billions of dollars in hundreds of mining projects. Some of these projects that we've invested in and are waiting for this US support. We've got investments in antimony, tantalum, titanium, copper, and rare earths and graphite in the fund. So we expect those investments to do well on the back of the US engagement in funding these projects moving forward. So what's really emerging here as a significant demand pillar in the metal markets, which we didn't really see when we launched the fund, is the strategic inventory demand from sovereign states, particularly the West. So this is the onshoring of metals. And it's not about the economics of mining projects and or its cost curve, but more about the consequences for sovereign states of not actually owning metal and then being exposed to the China-Russian trade weaponization trend that we see at the moment. So it's more the importance of having access to metal as opposed to the cost of acquiring it. If we use the graphite market as an example, there's roughly 500 years of supply at current rates in the graphite market. China produces around 75% of global supply and is one of the lowest cost producers at around $257 a ton for flake graphite. no other project on the planet at the moment can compete on commercial terms. Hence why China have got pricing power and have really priced out any Western market or miner from this market. So from an economic standpoint, you wouldn't invest in a graphite mine. However, given that graphite is a critical material in the defense industry, and that was highlighted by NATO as one of the 12 critical defense materials, not actually having access to a supply of graphite is more of a greater loss than the loss on the project economics of launching a mining in this environment or this price environment. So this picture is even worse or more acute if you look at the rare earths, where China controls 90% of the processing capacity for rare earths. So these are two areas where the US wants to fund the development of supply in non-Chinese jurisdictions. And this is another reason why the Chinese is introducing floor pricing above the current spot price to guarantee mining projects move forward. So from what I've briefly discussed here, you can see that there are many complicated issues that are influencing the metal markets, apart from the industrial demand of the good old days. I think, and we believe, that we're entering a new era for metals, which the Amati Strategic Metals Fund can take full advantage of. And I can highlight 6 reasons why you need to consider investing in metals, metal equities, and particularly the Strategic Metals Fund. The first one is, as George touched on, we're getting a US dollar debasement for fiscal superiority. And what that means is central banks are now focused on the debt sustainability or trying to control their bloated debt positions over inflation control. And what that means is they're going to try and lower rates to pay the interest on the debt, but that's a form of QE. Secondly, we're getting deglobalization and trade conflict and geopolitical risk. We see that all over. This is a structural inflationary pressure, and it's changing the way that the global commodities are flowing around the globe, and that's creating supply constraints of metal, duplication of inventory and stockpile, and increased demand. We're also seeing manufacturers moving from a just-in-time inventory management style to having inventory to rely on. Thirdly, we've got fragmentation of the global metal inventory, as I just said, and stockpiling duplications. That's basically in the east and west or global bifurcation here. Trade is being weaponized, resource nationalism and stockpiling is creating demand duplication. The fourth reason is that the global hard asset trade. What we're seeing now is a rotation from going to short bonds and fixed income to going long fixed assets and commodities. And there's an erosion here of the fiat purchasing power of central banks, and particularly the US dollar debasement, which is going to lead to higher metal prices, particularly in the precious metal sector. The fifth, we've got what I call a hot fiscal and monetary policy playbook by central banks, where they have to erode the real value of debt through inflation and QE. And that means currency devaluation, that creates higher metal prices, but also particularly eventually high precious metal prices as a play against debasement and inflation. And thirdly, sixthly, we've got an imperial style of confiscation and control of critical raw materials. So that supply security ex-China is really driving foreign policy. That's creating a bit of conflict, price volatility, but also onshoring and demand of stockpiles. So given all of the above, you think the market would have been a bit more exposed to commodities. What we're seeing and what we're hearing is the broader market is still underinvested in commodities, with only 3 to 4% portfolio allocation to a sector which has merits and longevity to go a lot higher. In a time, I think, when the focus is on metals for defense and security and the economic defense of wealth through precious metal ownership, the Strategic Metals Fund is well positioned, given the exposure we have, as George highlighted, to precious metals and critical metals in one actively managed fund, the two bookends to the fund. We have the ability to invest in mining development risk, which is particularly important as we get into an era of mining recapitalization and resource development. Remember that the two managers here, we're both financial investors, know our way around an Excel spreadsheet, but also mining engineers and geologists. And bringing that unique skill set to our fund is really paying dividends. As George said, 3 companies this year are taken out. Since the fund was launched, I think we're at 14 or 15 stocks in a tightly controlled portfolio, which has been acquired. So being invested in the small the mid caps, we also benefit from M&A, which we're starting to see. And that's a consequence of higher metal prices, higher equity prices, and also the acquirers can see increased future demand for metals. So as a fund, I'll give you an overview of the fund. And a lot of this information on the fund you can find in our fact sheets or on the website, amatiglobal.com. And also the presentations that we do on Bright Talk. But an overview of the fund, we've got around 42% exposed in gold, 17% in silver, 13% lithium, 9% in nickel, 7% in copper, 5% in diversified, which is the large miners. We've got 2.5% in rutile, 2.5% in graphite, 2% rare earths. That's in a holding of around 38 holdings, and 46% of the fund is in market caps above 2 billion. So we're not in the small caps, as some people think. We're in the mid caps. Also, 67% of our investments are in North and South America. Geopolitical risk and permitting risk are quite an issue. So we've decided to invest mainly in the Americas. We've got 58% of the portfolio in producers and 21% in developers. And what we like in the fund is really owning a mining company with a development asset. And why we like that is the market will discount the mining company or the asset when they start to develop their second mine because of development risk. So with that scenario, you're not paying for the developing asset in the portfolio of the mining company, and then you get the mining company which is producing great free cash flow at a discount, and that's where you make good returns. And we've got the ability with our technical background to invest in development risk. So I think with that we will finish, and if you need any further information on the fund, go to our website or approach our friendly sales force, and they'll be glad to help. So thank you.